Today I'm going to work with you about this post-acquisition consolidation exercise. So company P acquires 100% of company S for $100,000. So which means that company P pays S for $100,000 in order to get S 100% ownership. And on the date of acquisition, the book value of the net assets equals to the fair value of net assets. So fair value equals to book value. And then Supertrunk reported common stock of $8,000 and retained earnings of $20,000. The total is $100,000. So this is the AAP graph, I think. And then the first line is payment of consideration. Means that what you pay for the company, which is $100,000. Next line is fair value of net asset. And book value of the net assets. Since they are equal and they are all $100,000, so actually there's like zero AAP. So no AAP, no goodwill. First question says, prepare a journal entry made P's book during this year concerning the investment in the Supertrunk. So that means like January 1st, 2013, the parent company invests in us for $100,000, and when we pay cash, so that credit cash for $100,000. And then says during this year, so we also need to at the end of the year journal entry. So this subsidiary company reported net income of $20,000 and paid dividends of $10,000 during this year. So we can say investment in S is $20,000 because the parent company owns 100%. So we credit equity income for exactly $20,000 as well. And also this company paid dividends. We debit cash for $10,000. And then we credit investment for $10,000. Now this page is about financial statements of the parent as well as the subsidiary. So we can see there are some blanks that we need to fill in. And after we fill in those blanks, and then we can consolidate those companies. So first, let's see the income statement. From the subsidiary side, there's $20,000 of net income. So here we can plug in the earnings from Supertrunk, which is $20,000. And then we calculate this is $120,000. We minus the expenses, which gave us the parent net income of $62,000. And then this is the total amount, $20,000. And then we move on to the retained earnings. So the retained earnings, remember this is the beginning period, and we want to calculate the end of the period. So this is $62,000. We plug in net income, $62,000, which give us $212,000. There's no dividend paid or declared of the parent company, so then the retained earning would be still the same. And then $20,000 of net income we plug in here, which give us $40,000. And then we have $10,000 of dividends declared. So we minus this, and then they give us $30,000. So then we plug in here to $12,000 and $30,000. We can see that we still need to plug in the investment in Supertrunk of the parent company's financial statement. So this is actually equals to the total assets minus the total liabilities, which is net assets as well. And So this minus this equals to 110. So we plug in here. So now we finish all of the parent and subsidiaries, their each financial statements, and now we're going to consolidate those two companies. So we need to fill in the elimination entries. So why do we need to eliminate, and what do we need to exactly eliminate? So we all know in the income statement we have sales minus expenses equals to net income. And now in the parent financial statements, we can see like we have the $20,000 from the subsidiary, and this is for like the internal bookkeeping purposes. And we have this $20,000. Though when we consolidate, we want to bring all the sales and expenses on board. So if we bring them on board and still keep this, then we will have double accounting, because when we bring sales and expenses on board, they will give us the net income automatically, because sales minus expenses equals net income. So we need to eliminate the $20,000 for the earnings from SuperTrunk. And also for balance sheet, what we have is assets equals liabilities plus equity gives us assets minus liabilities equals equity. Same logic here applies. We want to bring aboard all of the assets and liabilities, so then we need to get rid of the investment account, because this investment account represents what subsidiary had right now. So there are two things that we need to eliminate here. The first thing is eliminate beginning of year investment. And equity of the subsidiary. And second, we need to eliminate changes in the investment account. Throughout this whole year. So first we need to look at the beginning of the year investment, so which is common stock. For the subsidiary, we have $80,000, and then retained earning. So because we need to notice the beginning of the year, so this gives us the end of the year retained earnings. So we need to go back. Beginning of the year is $20,000, which is $20,000, and then we get rid of the investment account, which is $100,000. And the second step is we need to eliminate changes in the investment account throughout this whole year. So what kind of changes we have? The first one is the net income, which is $20,000. Second part is dividend, which is $10,000. We all know that the retained earnings equals to beginning, so end of retained earnings is beginning retained earnings plus net income minus dividend. This is the first step. We already eliminated the beginning of the year investment equity. Now we need to eliminate the net income and dividends. So for the net income, we have $20,000. So here we have $20,000. We need to get rid of this. Just like I said before, so sales minus expense equals net income. And because now we have the net income, but we need to bring sales and expenses on board, so we need to get rid of this, because when we calculate sales and expense, it automatically gives us the net income. And then the dividend. We need to credit dividend here because dividend is a debit account. So dividend is $10,000. And then give us the investment is a plug. We need to get rid of this, $10,000. So now let's back to the sheet. We first eliminate the beginning of the year, so which is common stock, $80,000. And also the retained earnings. Remember, we need to eliminate the retained earning at the beginning of the year, which is $20,000. And then we credit investment account. So this is our first step. So second step is we need to get rid of any changes in the investment account throughout this whole year. So the net income we need to get rid of. Debit net income. And then we credit the dividend. Then the investment as well. So now we can calculate. This plus this equals to $150,000. And then we get rid of this. This is zero, $150,000. And then this plus this, $88,000. And because we get rid of this as well, when we consolidate, we get rid of the net income. So then give us $62,000 and then $62,000. So this is 150. And about this number, remember the first step we already eliminate the $20,000. So we ignore this, and then we ignore this as well because this is a net income. And then 62, we invest the $62,000. And then we have $212,000. There's no, like, we eliminate the dividend. So then give us the $212,000. Next, we move to the balance sheet. So this plus this equals to 62. This plus this equals to $850,000. And then we get rid of the investment account. So this is 0. And then this two plus together, $912,000. And then this plus this, $500. And then the common stock of the parent, $200,000. There's no common stock for the subsidiary. And then the retained earning here is a little bit complicated because we can say here we have $20,000 at the beginning, and then we plus the net income, $20,000 minus the dividend, which give us $30,000. So when we eliminate, that's what we eliminate from the first step. This is the net income, this is the dividend. We eliminate all of those two accounts in the second step. So then we eliminate this account completely, and then which leave us $212,000. So this plus this is $912,000.